Hello, welcome back. So today I'm going to talk a little bit about the hype that we've seen in the DeFi space, specifically one project. It's actually been one of the most publicized bull runs we've seen, or the bull run for a project that we've seen in a very long time. It listed on a number of decentralized exchanges at about $60 on the 17th of June, and then has since reached highs of over $360 on some exchanges and over 400 on others. Absolutely phenomenal run, and it only took about 5 or 6 days to get there. It's since retraced back, but we will get into that a bit later. So if you want to know the project I'm talking about, it's Compound Finance, or Comp for short. So it's definitely a story worth listening to because it does get a bit interesting. So let's get over WTF is Comp. So what's happened so far? Comp originally released their white paper in February of 2019, and then probably raised some seed capital, built an MVP, and then did a Series A raise at the end of 2019 for about $25 million. They then released their platform in May of 2020, where they started to allow people to borrow and lend funds on their platform. I'm going to go into a bit more detail about how it works in a little while. And then after officially launching, about a month later, on the 16th of June, it was voted by the existing token holders that the protocol would start releasing tokens to people who participated in the network. Yet again, I'll get into details into that a bit later. And that's when we saw the tokens hit the market at about $50, $60. On a number of decentralized exchanges. Within a couple of days, it had shot up to about $380 per token. This is because it was only available on a very few select decentralized exchanges like Uniswap. And there was major talks about that it was going to be released on Coinbase. And that's actually where we saw that $410 figure that I talked about earlier. This whole process only took about 4 days. It was pretty stellar. Now, the tokens listed on Coinbase on the 23rd of June, and actually the high was $427, which is absolutely crazy. So, since then, the token's actually fallen back to around $160, and at present is trading at about $200, give or take $20, depending on what exchange you're looking at. So what's the main reason for this rise and fall? Well, to understand that, we first need to have a look at how Comp works and what it is. So according to their own website, the platform itself is an algorithmic autonomous interest rate protocol built for developers. So what this essentially means is that users can either lend or borrow cryptocurrency through this platform, and the rates at which the interest is determined for lenders and borrowers is determined by a preset algorithm that has been built by Comp. And to put it shortly, basically it works on just supply and demand. If there's a high supply, the interest rate you earn and the interest rate you pay will be low. And that's assuming there's low demand. If there's equal supply and demand, interest rate will actually get quite high. If it's, I think at 100% utilization, it's about 40%. Whereas in assets that we're looking at on the website at the moment, if you look at something like Ethereum that has an excess amount of supply and not much demand, the interest rates are almost negligible. So people who participate in this network get rewarded Comp tokens. Now, the important thing to understand about Comp tokens as opposed to other things we've seen in the past is that a Comp token is a governance token, which means that holders have the right to influence the future direction of the network. And the way that this is done is that if you own more than 1% of Comp tokens in circulation, you can put forward a proposal. And then obviously the entire weight of the network will vote either for or against the proposition. At the moment, there's been about 12 proposals so far. Every single one of them's passed because the majority of the holders are venture capitalists who've invested in the first round of Comp. So that's essentially how that works. An interesting key to how this protocol is a bit different from others is that investments are pooled. So that sort of flattens the risk for lenders across the entire book of borrowers. So it means that essentially what I'm doing is I'm loaning my cryptocurrency in comp with a pool, a massive pool of other lenders, and then borrowers are then borrowing from that pool. So it means if a borrower defaults, or if something goes wrong, or it's highly unlikely with the way that it's structured, but if something goes wrong, it means the brunt is borne by all across the entire weight of the platform, which actually keeps the risk quite low. You're not entering into a one-on-one contract with an individual. So why the pump? Well, it's obviously, as a governance token, it's very different to the existing utility tokens that we've seen out there. It actually has a use case and users are being rewarded. This is a big trend that we're seeing in DeFi at the moment, in that as opposed to saying you pay me now for tokens and then later on you can use the service, it's saying use the service now and you'll be rewarded by tokens. And a lot of these DeFi operators are then building their business model around that, which is actually quite clever. It's also interesting to note that comp tokens are in very limited supply in the public domain. So we're only seeing it at current writing or recording, we're only seeing about 65,000 comp tokens being available in the market out of a total 10 million supply, because 4.2, so just under half of the total amount of tokens, is going to be issued to users over the next 4 years as an incentive to people to get on board. And from this, you can see that because there's such low liquidity, lots of publicity, FOMO kicks in and then the price just shoots up. Adding a Coinbase listing on top of that, it's going to go bonkers. And that's why we saw that. Then, obviously, people were doing things like farming. There's a number of different terms, yield farming, where you can basically, say, lend some USDT to the network, then borrow DAI, lend that back to the network, and then create this feedback loop where, although you're losing interest rate margin on the crypto you've lent and then borrowed against, you'll be earning comp tokens. And if they're valued at over, a couple of $100, it actually becomes quite a profitable exercise. Now, part of the reason that we've seen the drop, other than the FOMO wearing out and people taking profits on these ridiculously high token prices, is because more recently a lot of the proposals that have been put out by the comp network have actually been designed to reduce the ability of yield farmers to do what they want to do. So this is basically increasing the amount of collateral you need to borrow someone, either increasing or decreasing the weight of collateral that a certain asset may hold, so that people can't easily do these big feedback loops, because it's not really the way that the network is designed to be used. I mean, the main thing is it's meant to be people who are genuinely wanting to lend out their crypto and then earn a rate, and then hopefully people are on the other side who want to borrow the crypto so they can do something else with it. And that's essentially the way it's designed to work, and that's what they're sort of trying to move towards. So it means that a lot of these people who are farming tokens are basically just straight dumping on the market, which is why we've seen these massive price drops. But if you have a different opinion, or you think that there might be another reason behind it, please let me know in the comments below, because obviously it's all about learning. So the network is still continuing to grow despite the price fluctuations we've seen. I think when I first started looking at comp, there was about 600 million of assets that were being lent into the market. People had deposited about that amount of money. It's now at about 1.5 billion. So that's a fair amount of money. And the interesting thing is a lot of the assets are not these really volatile cryptos. They're stable coins like USDT or DAI or something like that. Like, we're not looking at these real volatile things that are going up and down. We're looking at things that are pegged against the US dollar. So that's an interesting about it. Now, it's not without its issues. Obviously, I've already mentioned the previous farming issue. But we've also seen that the amount of DAI apparently in the comp network, and this is because of this farming feedback loop thing I've talked about, is higher than the amount of DAI on issue. Now, I've got to delve a little bit more deeply into it, but I'm trying to keep this video quite short. But essentially, we can see that there's already a few issues, even in these really well thought out systems. And I think that, my view in DeFi, and I'm going to make a video on that a bit later, is that this is still an experimental phase. The same as the ICO phase was experimental in 2017 and the whole utility token thing. We still haven't seen a lot of experimentation with things like security tokens. A few people think that that's not going to go anywhere. However, in this space, I mean, just remember it's more advanced than we were and probably a bit more secure than we were in 2017 with that first big crazy run. However, it's still experimental. We still have to see how this new way of issuing tokens and this new business model is really going to play out. So that's essentially my brief summary on how comp works. So, I mean, if you have any questions, feel free to ask. I'm more than happy to answer. I'm trying to make these videos a little bit more simple because I can sometimes waffle on a bit, but thank you for watching. I appreciate everyone who's managed to subscribe so far. So I think I've hit about 100 subscribers. So thank you so much, guys. I'm going to start releasing a few primer videos because some of the interviews I've done and some of the videos I've made so far, I think some can be a bit much. So I'm gonna do that real fundamental stuff over the next few weeks, probably starting with basic blockchain stuff, basic token stuff, all that. I mean, there's plenty of stuff out there on the internet, but I think that it's important to basically try to put your own sort of spin on it, because then subsequent videos make a bit more sense if you understand where I'm coming from. But if there's any other DeFi projects you want me to sort of maybe do an explainer on or a brief chat about, because I don't think this was a comprehensive explainer, please let me know. And I appreciate you so much for coming by. Thank you so much.